Show. Infrastructure Capital CEO Jay Hatfield is here along with Annex Wealth Management Chief Economist Brian Jacobson. Jay, where are we in the party cycle? I mean, the music's still playing. Cops haven't shown up yet. People, they're not starting to leave, or are they? What do you see?
Well, we've been super bullish this year from the beginning. So we've been correct. And we even raised our target to 4,500 to 5,000. The only caveat right now is we have two overhangs. First of all, earnings season is going to end. So we get the September, October lack of information, which is typically bad for the market and a pullback. So we're getting a little bit cautious. And the other overhang is rates. We've been correct about the stock market, but rates have not come down. So we are forecasting we go to 3 to 3.25. At times we were close to that, but now we're at 4. And that's an overhang on the market as well. So we're turning a little bit more cautious and think that investors should just be aware that we might have a pullback, particularly in the tech stocks in September and October, like we normally do.
Okay, yeah, like you say, a typical August where we see a seasonal pullback. Brian, what do you see, especially considering you've got the economist hat on, that we got a better than expected second quarter print for preliminary GDP?
Yeah, so here at Annex on our investment, when we saw the GDP numbers, some of the details were really fascinating. We saw that areas like housing, manufacturing, and even equipment spending might be coming out of hibernation, coming out of the long recession that it's been in. But yet, at the same time, you have service sector spending beginning to slow. So maybe you get some stability with some of those areas like equipment and manufacturing, but slowing in services. And the net effect could kind of look like this very slow growth environment, which is likely to persist. Now, thankfully, maybe the market already priced in an earnings recession. And so we don't necessarily have to worry about retesting October's lows. But I generally agree with the other guests that, if we think 4,900 on the upside, think about the downside, the balance of risks here suggests to us that there's really no compelling reason to deviate from your longer-term strategic allocation.
Jay, I'm glad Brian brought up AI. So which part of the AI boom hasn't had the highest, timber or decibels at the moment? Because we know that the big names have really run up. But isn't there a point where the software side of this slows down or is oversaturated by new upstarts, and instead we start to see the hardware names have to catch up?
Well, we last time we were on the show, we were super bulled up about AI. I grew up in Silicon Valley and knew that was a critical development. So we recommended some AI stocks at that time.
In fact, let's put up the stocks that you had recommended the last time you were on, which was April. You said you liked Microsoft, which has had a very nice run up. You also mentioned, this is back in April, folks. This is why you have to listen to our guests here on the show. NVIDIA. Look at the NVIDIA gain, 72% since you mentioned it. And then you also liked Palantir, which today, I believe some analysts are saying Palantir is going to be a huge player. Already is. I mean, let's forget this gonna. It's already a big player in AI, has been for years. That one's up 140%, is getting a big bump today.
Well, it's important to keep in mind that we're GARP investors, so we don't really play the momentum. So Palantir was
even better because you were early.
Right. So Palantir was pretty fairly valued 140% ago. And now it's clearly expensive on a PEG ratio, so price to growth. And so we're a little more cautious, particularly going into September, October, so the momentum might cool down. NVIDIA is more interesting because they guided up 50%. So they're almost certainly going to hit that. If you guide up 50%.
Yeah, but look at the price to earnings ratio.
It's not as the earnings have been coming up. We're actually carrying an estimate for 24 higher than the street. We were at 12, the street was at 10 now, they're at 11. So the multiple's 42, we think the growth rate's 25, that's about a 1.7 peg. So it's actually cheaper than a lot of other stocks. But to be fair, it's a 2 beta stock. And we won't know till the 23rd, but we think the market will hold in till the 23rd because we need to know the sustainable growth. 52 is not per quarter is not sustainable, that's 200. But what is the sustainable growth? Is it 10 per quarter? Is it 5? Is it 15? And we're optimistic about that.
Okay.
But obviously, we won't know till we know.
I'm going to make our viewers wait for your new 3 picks because your last ones hit it out of the ballpark. Let me get back to Brian. And Brian, if you broaden the sort of discussion of overall at 30,000 feet investing, today the Wall Street Journal's website has this lead article, and the headline in it basically says, benefits of owning stocks over bonds keep shrinking. And basically, we know that the treasuries are almost risk-free, correct? And stocks, you got to get paid, right? You get paid or at least compensated for the additional risk of holding stocks through dividends. But, they're saying that it's not so much these days. Where do you stand on that?
I was really honored to be quoted in that article, and it was fun talking to the reporter about it, who did a great job surveying the topic, looking at the relationship between earnings yields and government bonds. I think that we have to remember that in the short term, government bonds are risky. We saw that back last year as far as the price volatility. And so when we kind of think about the risk-return ratio for each one of those, stocks versus bonds, you would expect to have a better ratio with bonds. Right now, things do look fairly stretched. However, if you were to actually look at, say, cash flow to price as opposed to earnings to price, it looks a little bit more normal. I can't say that it actually looks screamingly attractive, but at least it looks a little bit less compressed as far as that difference between earnings yields or cash flow yields and government bond yields.
Okay. And to yields on stocks, we turn back to Jay. Let's hear your three names because they all have pretty significant yields. Dividends.
Right. And so one thing I can certainly guarantee you, these picks are unlikely to be as much as the prior picks because these are low risk stocks with high dividend yields. But if we're correct about the environment, you want to be there. So the first is something you probably haven't ever heard recommended, but it's a preferred stock. It's SCE. Preferred
okay,
age.
hold on. That's SoCal Edison preferreds. The parent is Edison International.
Yeah, so you have very low default rate. It's actually technically a bond.
How do you buy that?
It trades on the New York Stock Exchange. Everything in our funds trades on a New York Stock Exchange.
Look at this yield, 6.1%. But you say next year that yield is going to reset at a much higher percentage?
Right. So what the companies do when they issue preferreds, they are callable at par. But the quid pro quo for many of them, and we have a lot in our main fund, PFFA has 52% floating, is that when they become callable, they go to floating rate. And normally, that wouldn't really help you that much if rates have been flat.
Yeah.
But because we have an inverted yield curve, the dividend yield is going to go from 6 to 9. And you do have a very strong utility, so you're really only taking market risk. So in other words, you have price risk, but you don't have a lot of default risk.
And you also like Boston Properties, which has a yield of about 6% as well. Nice move there. And MS, 3.7%. We've got to run. But gentlemen, thank you both so much. Brian, Jay, great to have you here. We've got the Dow clinging to about a 3-point gain at the moment. It's been very choppy.